Welcome back to Economic Outlook. Today I want to conclude my more detailed look at the crisis in Europe by examining its impact on domestic equity markets. In my last entry, I discussed how the crisis in Greece had caused appreciation of the dollar relative to the euro. This caused a flight to quality, where investors sold European debt products and purchased European treasuries. This reduced the yield for European treasuries and increased the prices of these bonds. Unfortunately, this has been good for bond investors, but the same can't be said for equity investors. Let's look at how the crisis in Greece has impacted U.S. equities and how this relates to the increase in treasury yields. The crisis in Europe has hurt equity markets both directly and indirectly. First, the strengthening dollar increases pressure on American exports and companies that do business overseas because their products and services become more costly. Remember, as the dollar appreciates relative to the euro, it costs more euros to exchange for dollars. Additionally, the direct exposure of some banks to risky debt instruments has contributed to the recent retracement in domestic equities. And more importantly, probably, the crisis in Europe signals political instability and hurts global economic recovery. Equity investors fear that protracted threats of European contagion and banking crises will hurt global markets and lessen the pace of overall economic growth. This is especially true for the large multinational firms that dominate major stock indices. The effects of the European crisis extend beyond the standard domestic bond and equity markets. Commodity prices will be affected by the increased value of the dollar as well. One example is the price of oil. As the dollar has strengthened, we've seen the price of oil decline from around $85 to below $75 at one point last week. This is partially attributable to slower economic growth and slack demand. However, oil is denominated in dollars, so when the dollar as a currency appreciates relative to other strong currencies like the euro, the price for a commodity for U.S. consumers will decrease. So one, benefit to a strengthening dollar is that commodity prices like oil will come down. However, this isn't true for all commodities. Interestingly, gold has actually seen its price continue to increase even as the value of the dollar has strengthened. This isn't typically what you would expect, but the increase in the price of gold reflects continued uncertainty about the stability of the United States debt market and its overall place in the global economy. Gold is typically seen as a hedge against inflation and instability. So when there's global instability like we're seeing today, where there are questions about the strength of Europe, about domestic policy in the United States, increasing debt relative to our own GDP, the price of gold will increase. So while other commodity prices decline, the crisis in Europe and to some extent the problems of debt in America are contributing to a continued rise in gold prices. The crisis in Greece has reinforced the idea that global markets are both more interconnected and interdependent than ever before. Even a small country like Greece can have a profound impact on global finance because of its membership in a currency union like the Eurozone and its associated exposure to international banks and financial institutions. Unfortunately, there are no easy ways to diagnose or cure future debt crises like this from happening. Investors must remain vigilant and monitor their portfolios for exposure to risks like these wherever they may develop. Thanks as always for joining me here at Economic Outlook. As an aside to some of my longtime viewers, you may be wondering about the actual loan package that the European Union and IMF agreed to send to Greece. Well, here are some of the details. The EU and the IMF will loan Greece $140 billion over 3 years to try to stabilize the debt situation in Greece. Now you may be wondering, who is the largest single contributor to the International Monetary Fund? Well, as you can probably guess, the answer is the United States. Therefore, by proxy, United States businesses and taxpayers will be footing the bill for at least part of the Greek bailout. Anyone who's watched my videos for any length of time probably already knows how I feel about this, so I'm not even going to get into it. I've had a bad week, the weather is terrible here, and I don't feel like getting angry and worked up again. So, as always, I hope you've enjoyed my look at the crisis in Greece, and I'll see you next week with a new entry. Thanks as always, and be sure to check out my website at www.econoutlook.com. Thanks as always. Bye.